All right, let's just cut through all the market noise for a second, Today, we're diving deep, and I mean deep, into the Cardano DeFi ecosystem to see what's really being built. We're going to uncover where the actual value is, what the risks truly are, and how people are actually getting involved. So, yeah, let's jump right in.
So here's the game plan. We're going to start with the big picture of Cardano as a digital economy. Then we'll zoom way in and put one specific DeFi platform right under the microscope. We'll explore the high-stakes game of liquidity pools, look at a totally different way to earn through staking, check out a brand new project, and finally, we'll pull it all together for the big takeaway.
Okay, first things first. Let's kind of shift our perspective here. I want you to think about Cardano not just as a piece of tech or some code, but as a living, breathing digital economy. I'm talking real financial activity happening every single day. To really get a feel for what's going on, we're going to put one platform right under the microscope. Our case study today? It's going to be Strike Finance. Looking at their data will give us a super clear picture of how these DeFi apps actually work and where the real opportunities and, the risks are.
All right, now we're heading into the engine room of decentralized finance. Seriously, we are talking about liquidity pools. This is the core mechanism, the absolute heart of it all, that lets people trade without some traditional bank sitting right in the middle.
So what in the world is a liquidity pool? Well, the easiest way to think about it is like a community-owned currency exchange booth. Anyone can add their tokens to the shared pot, and in return for providing that liquidity, they earn fees whenever someone else makes a trade. It's a collective way to create a market from the ground up. Okay, so here's a look at the actual data from Strike Finance. Now, don't get overwhelmed by all the numbers. Just focus your eyes on two key columns for now. APR, that's the potential yearly return, and then look at the weekly return, which tells us how things have actually been going over the last 7 days.
And wow, this right here just perfectly illustrates the two sides of the DeFi coin, doesn't it? I mean, look at this. On the exact same platform, in the very same week, you've got these wildly different results. The pool for the Snek token, it's up nearly 6%. Meanwhile, the WMTX pool actually lost money. So what's the deal? Let's find out.
Okay, let's zoom in on that Snek poll for a second. See that number right there? That's a projected annual return of, get this, 279%. It's this kind of mind-boggling potential that gets people so excited about DeFi liquidity. So what's driving that insane return? Well, a huge part of the story is utilization. Over 91% of the Snek tokens in this pool are actively being borrowed and traded. High demand for a volatile asset just means more trading, which means more fees for the people providing the liquidity, and that's what pushes that potential APR sky high.
But, and this is a big but, then you've got the other side of the story. The WMTX pool lost almost a full % in just 1 week. And this is a brutal reminder that you are totally exposed to the market's wild swings. You're also dealing with this tricky thing called impermanent loss, which basically means the value of your tokens in the pool can end up being less than if you just held them in your wallet. High reward comes with very real, very complex risk.
So providing liquidity is like making a bet on specific tokens. But what if you're more interested in the health of the platform itself? Well, that's where staking comes in. It's a totally different way to get involved with a completely different risk profile.
And that really is the key question that staking answers, right? What if you believe in the long-term vision of Strike Finance, but you just don't want to ride that weekly roller coaster of tokens like Snek or WMTX?
The process is actually pretty straightforward. You take the platform's own token, Strike, and you lock it up. By keeping it staked for a 15-day period, you earn a share of roughly half of all the platform's opening fees, paid out in Cardano's native currency, ADA.
Now this chart, this visual, says so much. Over 82% of all Strike tokens are staked. That's not just a number on a screen. That's a massive vote of confidence from the community, showing a real long-term belief in where this platform is headed. And that long-term belief, it's been rewarded. To date, the platform has paid out nearly 1 million ADA directly to its stakers. And this isn't some paper gain we're talking about. This is real value being shared with the community that's backing the project.
Okay, so Strike Finance is a more established player, but the Cardano ecosystem is far from finished. It's constantly growing. So now let's shift our focus to a brand new project, just to see what the very early days of a DeFi venture really look like.
And this is Pulse, a project that's literally in its first week. Notice the difference in their goals, right? We're not talking about APRs and pool utilization here. We're talking about the absolute foundational building blocks. Launch the network, get listed, and build a community. This is a snapshot of day one.
And even on day one, they're not just sitting around waiting for things to happen. The team has already bought back 8,500 ADA worth of their own token. It's a small move, sure, but it's a really significant one. It shows they're actively supporting their own market right from the very beginning.
All right, so after looking at an established player and a brand new one, what's the big takeaway from all of this? Let's distill it down.
Here's what we've uncovered. The potential for huge returns is real, like that 279% APR on Snek. But that potential is balanced by serious risk and volatility, like the loss in the WMTX pool. We also saw that community conviction is powerful, shown by that 82% staking rate. And finally, this ecosystem is alive and constantly growing, with new ventures like Pulse launching all the time.
So where does that leave us? We've seen the potential, the risks, and the rapid growth. In an ecosystem that's evolving this fast, the real question might be, what's the bigger risk? Getting in at the wrong time or not getting in at all? Something to think about. Thanks for tuning in.